Tobias Bucks from Ausbil Investment Management. Welcome.
Thanks, Drew.
Could you, as a starting point, define the smaller companies or the global smaller companies universe for us and your specific opportunity set running the global small cap strategy?
Yeah, sure. So it's 4,300 companies in 23 developed markets. So that's North America, Europe, and Japan, Singapore, Australia, basically.
And what sort of sectors diversification are we looking at there?
So a lot more diversification than you get in domestic equities. So domestic equities, obviously a lot of financials and materials. In global small caps, materials is only 7% of the benchmark, and only 2% of that's not metals and mining. The rest is construction materials. We've got heaps of industrials, we've got heaps of consumer discretionary, a lot of healthcare, a lot of IT, very, very differentiated and quite broad.
Yourself and Simon Wood are co-portfolio managers. Could you explain the kind of differentiating point that your team has compared to the others in the sector?
Yeah, so I think for us, unrecognised growth is probably really key for us. So we'd call ourselves growth managers, but we masquerade as value managers because our fund's cheaper than the index, and I think that's the key differentiation, Drew. We're cheaper than the index, we deliver earnings surprise, but we're still holding the next Amazons, the next CSLs.
And have you got some examples of that unrecognised growth in practice?
Yeah, I think so. So the trade desk one we've spoken about, we sold that now. That went up a lot through earnings surprise. Generac's one that's done very well for us in generators and really surprised the market. And InMode and Accor would probably be two more recent ones. InMode makes non-invasive aesthetic surgery equipment, and Accor does metal stamping for plastic pipe and cable conduits. And those are some more recent ones that have done a lot of unrecognised growth.
And consensus earnings are quite important in understanding how the outlook for businesses are. Can you talk about how consensus looks in the small to mid cap market compared to, say, the mega caps that are reporting quarterly and analysed within an inch of their life?
Yeah, look, it's a huge area, and I think it's only going in one way. The small caps, they quarterly report, but like you say, there's only 2 or 3 analysts on the stock, and those analysts are usually quite junior. They've usually not had a broad array of experience. The large cap stocks are covered by like 40, 50 analysts. Like you say, as soon as the quarterly announcement comes out, it's gone over in great detail. That's a great opportunity for an active manager, particularly in small caps. And then to cap it all off with MiFID in Europe and similar types of efforts to change the way broking's paid for in America, what that means is the quality and the level of the research is getting worse, we believe. So there's less analyst scrutiny and worse analyst scrutiny. So basically just more opportunities for an active manager to deliver alpha.
So alpha generation opportunities are increasing significantly.
Oh, yeah.
Have you got one more high conviction idea for us?
Yeah, so right now, I've got loads. I think Vitro Life's probably one we haven't spoken before, Drew, but it's in the fund. So Vitro Life is the global leader in IVF. They make the equipment, they make the media, they sell you the technology and the software for IVF. They're clear global niche leader in IVF. They're doing very well. They're Swedish listed. They're still not covered by anyone who really understands them. China's growing at 60%. America's about to kick off. And I think one thing about IVF is that it's something that's just going to continue as we get decreasing levels of fertility going forward with all the issues in the world. It's commonly known that we're getting less fertility, and people want to have kids older for financial reasons, and they just want to grow and enjoy life. And all those things mean that IVF, I think, has got a very excellent future. Now, what's key for us about Vitro Life is that they're the niche leader, they've got opportunities to deploy capital to keep growing, but they consistently beat on earnings surprise, and that's where you get the long-term value creation on top of being the niche global leader.
So you mentioned you recently exited your holding in the trade desk. As a small to mid-cap manager, is there fixed rules around that, or how does the thesis come up to remove one of your best-performing holdings?
Yeah, look, it's always an interesting decision and a really interesting question to ask people, particularly the question I like to ask other fundies, because it's interesting when someone lets go of something. For us, it's about unrecognised growth and growth. So when we see the sell-side expectations, what the market's expecting, come close to what we're expecting, we don't see that much unrecognised growth. And if there's not a big gap between what we're expecting and what we think the market's expecting, that's when we sell because we think it's valued. Or if something materially changes. So sometimes investment corporate roadmaps change, and sometimes we don't agree with it. So sometimes they'll make an acquisition that we don't think's right or something like that. So those are the reasons that you sell when it's great, when you've made a lot of money because the growth isn't unrecognised anymore, and take your profits. And then sometimes you sell because things change or you just didn't get it right.
So not just because it enters an index or...
No, No. It's about the unrecognised growth and how many dollars a share you're going to get.
Excellent.
Thanks.
Thanks.